Hello and welcome to this session in which we would look at auditing notes payable transactions as well as related balance account. In the prior sessions, we looked at notes payable, and specifically we discussed notes payable internal control and notes payable in terms of being part of the capital acquisition and repayment. What's the capital acquisition? Capital acquisition means raising money. The company need to raise money. How do they raise money? They raise money through debt, and we said notes payable would represent the debt aspect of it, and equity, which we'll discuss equity next. In this session, we would be looking at how to audit notes payable. But remember, this is part of the capital acquisition and capital repayment. So notes payable, everything that we talked about notes payable, in a sense applies to bonds payable, mortgage payable, leases, long-term debt. So the purpose is to verify that notes payable are accurately recorded. We record them properly, classified properly, and fairly presented in the financial statement. Now, why? Why do notes payable matters? Now, we all know why it matters. Debt is important. Why? Because it affects key financial ratios like liquidity ratios, like debt to equity, debt ratios, and disclosure. Misstatement and debt could lead to serious financial misrepresentation. If you're hiding debt, which is off balance sheet, that's a serious problem, because when debt blew up in your face, the company might go down. And this is what happened in case of Enron. They were hiding debt. So it's very important. One of the things that they were doing, they were hiding debt. They were doing many other things, but I don't want you to think that's the only thing. But hiding debt, think about this. If you can hide debt, think about if you want to borrow money from the bank. You go to the bank and they pull your credit. And there are certain loans that don't appear on your credit. This is what we mean by hiding debt. So we want to ensure that all management assertions about the debt, such as existence, completeness, valuation, classification, are valid. And this is what we will do today from a transaction perspective as well as balance account. Now, the key audit procedures that we are going to perform here are: we're going to confirm balances with creditors, inspect loan agreements, recalculate interest amortization, review disclosure, as well as other steps. So how am I going to explain this? Here's how I am going to go over these audit procedures. The first thing I am going to show you is a completed schedule by the auditor. I'm going to show you what the schedule would look like, and I'm going to tell you this is what the end product would look like. Then, as I'm going over the auditing of the transaction and the related balance account, I would say, you remember we talked about this in the final product. So let's go ahead and get started by first looking at the final product, then go over the steps. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
The final product would look something like this. This is a schedule for long-term debt and accrued interest payable for Robertson Technology. Excellent. Now, let's first look at this. They have 3 loans. 1, 2, 3. They have Liberty State Bank loan, they have a Horizon Leasing, and they have a North Star bond. Those are the 3 debt. Then we are showing the due date for each debt, year 28, year 27, and year 30. Then we have the face amount of each debt. Then we have a security. For example, Liberty State Bank, they purchased this. They purchased a machinery and equipment, and that's why they took the loan for $8.5 million. Then there's this audit tick mark C here, and if you look at C, agreed all information to confirmation. What does that mean? It means we looked at the confirmation, and most likely confirmation from the bank, telling us that this loan is against this machinery. So notice what we did is the tick mark is C. Then the beginning balance is 1.5 million. Usually the beginning balance is coming from the prior year. Usually that's the case. We have additions. We borrowed more money. for that loan. I guess maybe we needed more money. Then we made a payment. The payment, there's a tick mark Y. Why? Traced payment to cash disbursement journal. So they paid 250,000. What we did is we took that 250,000, we went back to the cash disbursement journal, and we confirmed that the payments were made. The ending balance for this loan is 2,050,000. The related interest is 3,750. The expense, the beginning interest, we expensed 65,000, and this is through the tick mark lambda, and we recomputed the interest expense. Then we paid 63,500. Most likely, we also traced this to the cash disbursement, and the ending balance is something that we computed for interest. We did the same thing for the second loan, the third loan. Then what we did is we footed all the beginning balances, we footed them, and the tick mark is F, and basically this should, confirm to the ending balance of the prior year. We footed all the additions. Notice these tick mark. Let's see what else. What else do we have? We have L, agree to the general ledger. Let's see if we have. Okay, before we do the L, let's look at the check mark. The check mark here is tested amount of the current portion of long-term debt. So what we did for classification purposes, we have $500,000 in what? In current portion of long-term debt, and the long-term debt is $5,875,000, and we footed F is we footed everything. So this is basically what I'm showing you here is the end product. After we have done the work, we place tick marks to indicate the work that we have done. So this is the end product. Now let's take a look at specifically the assertions, the balance sheet related assertion or classes of transaction, and the balance related assertion. Let's start with the assertion about classes of transaction, and we'll start with occurrence. The first thing is occurrence. Basically, we want to know for sure that a transaction took place, it occurred. What do? Well, we examine copies of the new note, the agreement between you and the bank, or the bond, and the financing agreement. This is for the example, for this example. This is what we'll do. Whatever it is, to ensure recorded debt are valid and transaction actually took place. Now, no one will usually add that. So occurrence is not a big issue for debt. Think about it. No company will record that that it did not really occur, it did not really happen. Nevertheless, we want to make sure it's recorded for the proper amount. We could also examine the board of directors minute for approval of new lending agreement. We want to make sure that there is an agreement, there is an authorization. Remember, we talked about authorization in the internal control session. This loan was authorized. Here we confirm documented authorization and approval, reducing the risk of fictitious transaction or fraudulent transaction, because again, no company would record a loan that they don't really have. So this is what we do for occurrence. And then we have to look at completeness. Completeness is important because we want to make sure all the transaction related to notes payable and liabilities are reported. We can trace cash receipts and cash payment to source document and general ledger. Usually cash receipts. When we receive a large amount of cash, suddenly we deposited $800,000 in one lump sum. Well, we need to know where did that transaction took place. Was this a loan? So ensure all significant transaction involving cash related to that are recorded. So basically you go through the cash ledger, and every time you see a payment to cash, a large deposit, which is relative to other transaction, you might have a lot of deposits that are 10,000, 5,000, 7,000, and suddenly you see a huge deposit of 500,000. Well, that's not, most likely that's not a sale. That's a good chance that that's a loan that they obtained from the bank. We would also review interest expense for payment to debt holders not listed on the debt analysis schedule. We look at payments that are tagged as interest expense. Great, those are interest expense. Show me, I want to trace to which debt they belong. So if I see that I have the interest expense and the debt is recorded, then I have the debt. But let's assume I saw an interest expense payment. I'm looking for the related loan and I cannot find the loan. Well, that's a loan that's not being recorded. So checks for unrecorded liabilities by reviewing payment that don't match a known obligation. That's a problem. How come you're saying this is an interest expense? An interest expense is for a loan. Where is that loan? Review notes paid or renewed after the balance sheet date to determine unrecorded liabilities. Look for large payment that were made after the balance sheet date and see if that liability existed or if you refinance that debt. Identify liabilities existing at year end, not reflected in the financial statements. If you paid that debt, well, that debt should have been existed as of the balance sheet date. How come I don't see it? You also could evaluate lease contract to determine whether the lease is an operating or a finance lease, but now it doesn't really make a big difference because all leases, they will have to be recorded as a liability. Let's take a look at this multiple choice question from farhatlectures.com. The test of detailed off-balance procedures that may uncover unrecorded notes payable would be to what? So here you're looking at a procedures that is designed to do what? To uncover unrecorded notes payable. So a notes payable that you have, a loan that you have, but the company hid that loan. Okay. Foot the notes payable list for the notes payable and accrued interest. Is this something that you have to do if you have a notes payable? Of course you want to do that. You want to foot the total. We did that. But does this uncover any unrelated? No. This is make sure that when you foot them and you compare them to the general ledger. It's a detailed tie-in. You're confirming the balances for accuracy. It's a procedures you undertake, but it's not to uncover unrecorded liability. B. Examine notes paid after year end to determine whether they were liabilities at balance sheet date. So if the year end is December 31st, what you do is you look at payments made after December 31st, maybe a month or two, to determine if you paid a loan. And if you paid a loan, was this loan existing as of December 31st? C. Examine corporate minutes for loan approval. Is this something that you have to do? Yes, you want to do that. For what purpose? Examining the corporate minutes will tell you whether the loan actually legitimately exists. You're not looking for that. You're looking if all loans are recorded. Uncovering unrecorded, it means you're dealing with completeness. Corporate minutes helps with existence, occurrence. It could help with unrecorded notes, but the payment at the end of the year is a better. So between B and C, B is a better answer choice. I mean, I'm not saying C is totally wrong, because if they mention the notes and the minutes, then you want to see if it's there or not. So if it's not there, you can determine that. But that's not the purpose for it. Loan approval satisfies the existence audit objective. That's the main purpose of it. Notice here for loan approval. D. Examine duplicate copies of notes for principal and interest rate. That's good, but how would that help? That would help with the computational aspect of the loan, accuracy, but not to uncover unrelated loan. If they're telling you we have the principal, we have the note, the principal, it means it exists. It's completed, it's there, they're telling you it's there. But when you examine a payment and that payment don't reflect a related liability, you are looking for uncovering unrecorded notes payable. What should you do now? You want to look at Farhat lectures. Go to Farhat lectures. Look at additional resources that include multiple choice, true, false, additional lectures. Whether you are a CPA exam candidate or an accounting student, the best investment you can make is investing in yourself. Good luck, study hard, and of course, stay safe.